so let's start talking about rental income. And we usually think of rental income, you know, from the rental of real estate, right? Residential rentals or commercial rentals. You know, renting it for, you own a piece of property and you rent it out for somebody either to live in or to use for business purposes. But rental property is also like personal property. So, you know, you think about, you ever go to Ace Hardware and rent a tool for the day, something like that? That's rental. That's, you know, so personal property can be included in that as well. They talk about here, so if you're a real estate professional, that would go on a Schedule C, but we're not talking about real estate professionals here. We're talking about individuals who own a piece of property and for whatever reason decide to rent it out and then generate income from that. Rental income is not subject to self-employment tax if it is passive. Rentals are, however, allowed that 20% QBI discussion if the taxpayer is a rental professional and they work in the rental for more than 250 hours. So there are certain parameters under which they would actually get that QBI benefit as well. So example here, Jack, real estate professional who owns and operates a bed and breakfast in the North Carolina mountains. He's probably got some problems right now with his bed and breakfast. Jack provided significant services to the renters, has no other trade or business. As such, this activity is treated as a trade or business, not as rental property. Consequently, he reports the rental income and expenses on this property on his Schedule C. So this is where he is actively engaging in the rental of that property. And like I said, you know, right here, they talk about 250 hours. There are a lot of, in the determination of whether or not you are actively engaged, there are all sorts, there's a big long list of different factors that you take into consideration. So, you know, there are some specific rules with regard to defining whether or not you're actively participating or not. So it's not just the taxpayer deciding whether they're actively participating or not. Farm rental income is a little bit different. Like I said, you know, several times, farms are unique. Farms are different, they're treated differently for tax purposes in a lot of instances. For rental, they are as well. Oftentimes, you guys are all living in Iowa, you may, or depending upon your experience with rural Iowa, you may or may not be aware that a lot of individuals who own land, they don't farm their own land. They will rent it out for somebody else to farm that land, but it's farm rental income. So they're not getting the income from the crops, but they're getting their income from actually renting that land to somebody else who's then going to manage those crops or livestock or whatever it is. But if that is the case, then those activities are reported on Form 4835, which is a separate farm rental. We're not going to go into that form, but they do have their own form for that. If you think about it as well, the energy companies that are renting or leasing land for the windmills as well, that's another form of rental income. That's kind of a more complex issue, but part of that would be rental income as well. So what we're really talking about here are, you know, rental income mostly from the rental of residential real estate, commercial real estate, and personal property. So as with the requirements for expenses that we talked about in chapter 6, they have to be, all the expenses have to be ordinary necessary expenses in order to be deductible for rental purposes. So that definition holds throughout the tax code pretty much with regard to whatever income or expenses that you are, that we're talking about. The gross income, and we're gonna talk a little bit about what exactly that income is. Like, for example, when you have a rental, usually you have a deposit, right? The renter or the renter will pay a deposit up front. So is that considered income? What exactly is included in that? So we will get to that. So it works, the Schedule E works just like, kind of like the Schedule C does, where it's an income statement. You get your gross rents up at the top, and then all of your expenses are listed, and the expenses that are listed on Schedule E are expenses that are typical of rental properties. But of course, there's a space for other types of expenses as well. But a lot of the expenses are unique to rental properties. Things like mortgage interest, property taxes. You've obviously, with a Schedule C, you may or may not have property that Schedule C owns. But with a rental property, generally speaking, you own the property. So there might be, you might have a loan on that property. So things that are also depreciation, which we covered in chapter 6 as well. So those are some of the more common types of expenses that would be associated with that. So rentals income do not cover security deposits. So if you have to make a deposit of $1,000 up front the renter has to make a deposit of $1,000 up front in order to rent the property, and then it's $1,000 a month. That $1,000 security deposit, if the renter has the right to have it returned to them, provided everything is okay, then that $1,000 is not considered income. Essentially, it's just their money that the renter or the rentee is holding on their behalf. So that would not be included in income. If, though, they get to the point where at the end of the lease, the end of the rental period, some or all of that security deposit is kept because the renter did not meet the conditions to get it returned to them, at that point it would become income to the owner of the rental property. So here we've got Della received $7,000 from Philip to cover 6 months of rent from December 15th to June 15th. The payment includes a $1,000 security deposit. Della must include $6,000 as rental income in 2023. The $1,000 is not reported as income, but again, we're cash basis. So she received the cash in 2023, even though it covers through 2024, because it was received in 2023, that is going to be considered taxable income in 2023. Services provided in lieu of rent payments are also included in rental income. So here's an example. Bill owns a house, rents it for $900 a month. During the winter, while Bill was on vacation, the furnace failed. The tenants of the house had the furnace repaired and paid $300 in repair costs. Oh, this is kind of a little bit different. I've got another example here of services, but this is where the tenants are paying something other than cash. It's still considered to be rental income. Tenants had the furnace repaired. On the following month, the tenants reduced their rent payment by $300 because they paid $300 to have that furnace repaired, right? So they paid $600 in that subsequent month. Bill still has to include $900 of income because he got the benefit of not having to pay that $300 that he was responsible for. Now the other side of it is he's going to get a deduction for the $300 because essentially that's, he didn't get the full amount. It was in and out, right? So he has to report the income, but he also then gets to report the expense on that side. So here he owns a second rental house in need of repairs, allows a new tenant to live rent-free for 3 months. This is an exchange for services example. Tenant is going to complete the necessary repairs. So the value of the 3 months of rent is $1,800. Bill is going to include $1,800 of rental income because he's getting, in effect, $1,800 of services from the carpenter who is renting the space. But then he will turn around and take an $1,800 deduction for the cost of the repairs that are being done. Okay. And as I mentioned here, assuming they are not capital improvements, we're going to talk about that a bit as well. It's important to be able to distinguish between what is a capital improvement and what is a repair. That line is sometimes kind of fuzzy. Again, expenses have to be ordinary and necessary. Same criteria as we talked about in chapter 6 with Schedule C's. Let's see. Travel and transportation can also be considered part of one of the ordinary and necessary expenses for a rental. If you have to travel to the rental to make repairs or just for general management of the rental, that would be included as an ordinary and necessary expense. Again, travel, if you have to stay overnight, same rules as what we talked about in chapter 6. So in that case, then the meals would be deductible. 50% of the meals would be deductible. But you got to be careful, again, if there were elements of personal vacation involved in that, you got to take all of that into consideration as well. Usually with standard mileage rate, same standard mileage rate that for rentals as it would be for business. So what was it, 62 and a half or something like that cents per mile in 2023. All right, so some common expenses: advertising. So if you advertise to rent the property, the travel to and from the property, repairs and maintenance, normal repairs and maintenance that are not capital improvements. That would be something that you're just bringing the property back up to its usable condition, not improving it in some way, not adding value to it. You're just maintaining the value of it. Insurance would be included in this as well. Management fees, so if you hire another company to manage the property, that would be a common expense. Interest payments on mortgage, or like any loans that were taken out to improve the property as well, where the property is used as collateral, so the interest on that. Property taxes, and then our depreciation. So if it's a residential property, we're going to use that 27.5-year straight line method for depreciation. If it's a commercial property, then we're going to use the 39-year straight line method for depreciation. Some examples that they've got in here of capital improvement. So if it's a capital improvement, it would be depreciated. And remember, we've got some restrictions on rental properties and depreciation. We can't take that 179 deduction. There are certain times when we can, if it's a capital improvement, but most times we can't take advantage of that 179 for things of this nature. So there are some restrictions on, and we would have to just depreciate the items over the regular time period. So anything like additions. If you make an addition to the property, then of course that's an improvement. It's probably going to increase the value of the property. Built-in appliances, kitchens. These are things that they generally have to be attached to the building somehow, right? As to be part of the building, which means they're going to be, when they are depreciated, because they're part of the building, they're going to be depreciated over that 27.5 years. One of the things that's kind of surprising, like heating and air conditioning, all of this stuff, like no HVAC system is going to last 27.5 years, but you have to depreciate it over that 27.5 years because it's attached to the building. So it becomes part of the building. But just kind of I'm not going to go through all of those, but things that would be considered to be capital improvements. So an example of the travel costs, again, they're just using the mileage rate. I guess it was 65.5 cents a mile, 2 trips, 602 miles. So they would get this person gets a deduction of $789 to offset that rental income. So capital improvements, so repairs and expenditures that neither materially add to the value nor appreciably prolong the property's life would be considered repairs. And they are you can expense those immediately. So you can take the full full cost of that repair and offset the income from the property. If, however, it adds to the value of the property or it prolongs the property's life, that would be considered a capital improvement and it would have to be depreciated. Let's see. Yeah, I mentioned that. So certain small rentals can elect to deduct in full certain improvements as expenses. This is not like the 179 deduction. It's just allowing you to write on the Schedule E, deduct in full some capital improvements, up to a maximum 2% of the building's unadjusted basis. So that would be whatever it was paid, whatever you paid for it. So if it's $100,000 up to $2,000 or $10,000. So whichever one is larger, that you can go ahead and expense, as long as you have rental receipts of less than 10 million, or your property has a basis of less than $1 million. All right. Talked about the depreciation here. 179 is not allowed. 100% bonus would be allowed if the property has, we're talking about, has less than a 20-year life. So we're not talking about anything of those capital improvements that are attached to the building, but maybe things like, I don't know, what would be a good example? Things like appliances usually. Appliances are usually not considered to be attached because they're just plugged in. So appliances would be one of those things that you could take the bonus. And look, again, so they're saying 100% bonus. It's 80% bonus, so we'll be careful there. Let's see. One of the factors that's kind of interesting with regard to rental properties is, like, when you purchase a rental property, you're not just purchasing the property, you're purchasing the land that's attached, that the property is attached to. You're probably also purchasing different components of the property, like the appliances that are included in there, or the carpeting, or the landscaping, things that don't necessarily have a 27.5-year depreciation life. So you can choose to pull those different components out when you are depreciating the whole of the property. That is advantageous in the short term because then you get a higher depreciation deduction. So if you are, and I guess I'll go through this example here. They got an example here that kind of illustrates what I'm talking about. So you can accelerate the depreciation deduction if you allocate the purchase price to the structure separately from any other components that might be included in it. So if there was like furniture that was included in it, you can pull the value of that furniture out and depreciate it separately over 7 years, rather than the 27.5 years of the building as a whole. Appliances, carpets, and shrubbery or fences, they have different class lives. So you can pull those items out and depreciate them over a shorter period of time than the overall 27.5-year period. Oh, and yeah, for rental properties, if there's furniture involved, it's a 5-year life rather than 7 years. So they have a special class life for it because it's going to get beaten up a little bit more than just normal. So here's an example of how what this would look like. And like I said, you also have to separate the land value out of it. Usually what we would do in practice is we would look at the property tax. You can look up property taxes online. There are websites for that. So if you have somebody, you wonder how much what they paid for their house, you could actually go and look that up. But they have as well in there, like, the assessments and what the amount of the assessment that is for the building and the amount of the assessment that's for the land. And usually what we would do is use those percentages. We take a percentage, and when we're depreciating, we pull then. So like, for example, if 20% of the value was for the land, the assessor decided it was 20%, the full purchase price was $100,000, we would allocate $20,000 to land, $80,000 to the house, to the building. So we're going to depreciate $80,000. We're not going to depreciate the whole $100,000 because land is not depreciable. So in this example, we've got Alan and Cherie Masters. They purchased a furnished beach house in San Clemente, California for $1.364 million on June 1st, 2023. Land, part of that was valued at $700,000. Furniture, $15,000. Appliances, $3,000. Carpet, $4,000. Landscaping, $8,000. They rent the house full time. There's no personal use of it. If they depreciate the house as a single lump sum, so they put it all together, so we'd have to pull out, we still have to pull out the $700,000 for the land. The rest of it would just be to the house, $664,000. The depreciation deduction that they would get this year is $13,081. This is that percentage that would be on the table, the depreciation table that we're all familiar with. If, however, they divided the assets into depreciable components, so they would pull out the furniture, which was worth $15,000. They could depreciate that over 5 years. Appliances, $3,000 over 5 years. Carpet, $4,000 over 5 years. Landscaping, $8,000 over 15 years. They pull those amounts out of the 664, which is what, $30,000. So they're left with the house is $634,000. That's what they're going to depreciate over 27 and a half years. These other items they're going to depreciate over their shorter class life, and then they get a depreciation deduction of $17,290. So you see their immediate deduction is greater because they pulled those components out and separated them. So they'll get a reduction if they're in the, that's a additional deduction of 4209. So if they're in the 22% tax bracket, it's going to save them 22% of 4209. They'll pay less in taxes. Oh, let's see. Oh, so this is the Schedule E and what it looks like. Again, this question, we had this on the Schedule C. Did you make any payments that would require you to file Forms 1099, which is possible. If you are paying a management company as the owner of that rental property, you're supposed to send them a 1099 for the amounts if you paid them more than $600. So if you did, then yes. Did you or will you? Well, yes. Again, if you checked yes, you're not going to check no on the second question. So you've got space here for the different types of properties. So you got 3 different properties here that you can list on this row. Each of these rows then pertains to columns. So you can see we're only filling in row A, but row A pertains to this row A and this column A. So if you had multiple properties, B would pertain to B and B. So address here, and then over here they ask about the type of property. What is this? So the key is down here. Number 1 is a single family residence, multiple family residence, so a duplex, triplex, apartment building, that sort of thing. Vacation or short-term rental, so that could be Verbo or something like that. Commercial, so like an office space or warehouse, that sort of thing. Land, if you're just renting land, and that would not be farmland, that would be for something else, some other type of land. Royalties, which we will get to. Self-rental, which is where you own a business and you own the building that the business operates in, and you are renting the building that you own from yourself. It's brilliant, actually. And it's a good tax move. It's a good long-term move. So, and a lot of CPAs and law firms will do this. So they'll form a separate LLC to own the building, and then you have your business in the building, and the business rents space from the building company that you also own. So you're going to you pay rents to yourself, but then you get a deduction from this Schedule C business, or this business that's probably paying self-employment tax. You get a deduction for the amount of rent, but then you're also getting the rent income, but you're not paying self-employment tax on that, right? So anyway, so that's kind of what a self-rental is, and then some other types as well. It's like a tax planning sort of thing. Okay, so the type of property here, so this is for property A. It's a single family residence. Fair rental days, personal use days. We're going to talk about this, why this is important. These numbers will determine how we report the income and the expenses from that. QJV, that's called a qualifying joint venture. Your book doesn't talk about what this is, but oftentimes what happens is So each individual who owns the rental is really supposed to report their own income from that on a, well, let me back up. If more than one person owns a business together, that's considered to be a partnership, right? So if Amber and I own a business, we're not gonna file a Schedule C, we're gonna file as a partnership. And then the income from that partnership is gonna flow through to our personal return. If, however, I own a rental with my husband, which oftentimes happens, right? If you own a rental and you're married, chances are you're both gonna be owners of that. Instead of having to file that partnership return, because it's still two individuals, you can click this off and you don't have to file the partnership return. Each individual will report their own Schedule E, so that they won't do it together, but they don't have to file a partnership return. So that's what that QJB is. Got to put the rental days in and the personal use days. So like I said, just like an income statement. So we got the rents received, royalties. If it was royalties, like if this was a 6 up here, then any royalties would be listed here. And then all of our expenses listed, including depreciation. And then we get our total amounts report on line 3 for all rental properties. So and these get combined. So if you have multiple rental properties, it all gets combined into one amount. Income here, line 12, what is line 12? Mortgage interest is separate. Line 18 is depreciation, and total amounts on line 20 for all properties. And then we get down to what our net real estate income is. So you can take a loss on real estate property. This is one of the benefits. So if you have a couple of properties, one of them's losing you money, the other one, or that depreciation deduction, it's not a cash expense, right? But if you've got, like, look at this, $17,290. If their rent was like $10,000, they're gonna have a loss on that due to depreciation. It's not cash that they spent on the depreciation, right? But it's because they didn't spend money to get that deduction. They could end up with a loss, or combined have other properties where there's a gain and a loss, and ultimately you get a loss. You can take a loss depending upon what your other income is. If your other income is, I think it's still, as married filing jointly, less than $150,000, then you can go ahead and take the loss up to like $25,000. If your other income is over that, then you can't take that. Loss. Let's see. So you guys are all familiar with this. This is just the depreciation. So this is what the building, all that property would look like on the depreciation schedule. So we've got the building itself here, the 15-year property, the 5-year property, and then the depreciation deduction there for all of that. I guess there's nothing on there. What else do I want to? Oh, so again, so this is what I was talking about. If a rental property incurs a loss or potential limitations on the deductibility, it's a passive activity. Chapter 13, which we don't go into, talks about passive activity losses. But that's just kind of a summary of the rules for those passive activity losses. Okay? Questions so far?